Welcome to Chapter 4, the accounting cycle. Okay, so when we talk about the accounting cycle, what does that involve and what does that do? Well, the definition of what the accounting cycle is, it is basically it's a method that we do to, number one, to ensure the accuracy of our accounting, but our ultimate goal here is that we are going to collect our source documents, go through the whole accounting process where we go through the journal, we go through the ledger, we go through the trial balance, and there's a sequence of the exact way that we are processing the accounting cycle, okay? And how frequently we complete this accounting cycle, right, is going to be determined by the accounting period. Now, it's not just collecting and just recording and processing the accounting information. We'll go ahead and talk about the exact 10 steps it takes to complete the accounting cycle. Okay. Now, what's the purpose of creating financial statements? Well, in this case, right, we have 4 characteristics. That is, the financial statements must be reliable, relevant, consistent, and comparable. Okay, so let's talk about reliable. Okay, because we have source documents to back up that proof of a transaction has occurred, the information must be reliable, meaning everything that you do and record must be backed up by some kind of source document, whether it's a receipt, an invoice, a bill, a check, right? All of those have some kind of proof that a transaction has happened. So therefore, the information that you produce should be 100% reliable, okay? In this case, right, when we talk about financial statements, you can't create invisible stuff out of nowhere, right? You must have the source documents to back it up. So that's why the information must be 100% reliable, okay? Second thing is going to be relevant. Now, in this case, relevancy is going to be in terms of time, okay? Not in terms of whether they're related to each other, okay? It's going to be in terms of time where your transactions or everything that you record should be relevant in time, where you're recording transactions on the daily, where you're not picking a specific time period that you're recording in. So the information should be relevant, meaning up to date. So if you're currently working in let's say 2021, right, and you're recording all your transactions, you shouldn't have a transaction that you recorded back in 2015. Okay, if that makes any sense, right? That is irrelevant. It's not in the same time frame because, again, when we learn about the rules and regulations between GAAP also tells you that, hey, the dollar isn't going to withhold its value from 2015 to 2021, right? It's completely a separate value. So that's why we must keep our transactions and our, journal recording, right, within a relevant time period, right? Because again, a great example is that the dollar can change its value over time, and we need to stay in the relevant time because also that too, GAAP rule, tax rules, they all change every single year. So we want to make sure that we keep our tax tables up to date as well. So making sure that we're in the relevant time period. Okay. And then being consistent. So when we actually learn throughout this entire course, right, I'm going to be teaching you different methods on how to do specific tasks or specific topics. Okay, so for example, inventory. There is 2 ways that you keep track of inventory. And then beyond that, there is 3 different ways that you can keep track of costing the inventory, all right? And when we talk about methods, right, that's where we have to be consistent, all right? Where we choose one method and we stick with it throughout the entire process of your recording process, okay? Reason being is if you keep flopping and flipping into different methods because you can't figure out what works best for your business, that's not going to give you very accurate information. So if in the first year, I decided to run my books under a cash basis versus and then the next year I did accrual basis, right? I cannot compare my profit and loss statement from year 1 to year 2 because they're completely two different methods. It doesn't show us any connections between the two because one is looking at actual cash and the other one is looking at actual accrual. Now, of course, there are rules and regulations that you can go through with the IRS in regards to making those changes or establishing those changes because once again, the IRS will also give you time frames or give you exact instructions on if you are planning to change methods. You have to let the IRS know so they can be able to follow along with your profits and loss that you have to submit to the IRS. Okay, so again, being consistent is one thing. So trying to figure out from the very beginning, sometimes it can be hard to tell, especially if you're not sure and you're opening your business for the first time. Now, of course, they also do recommend maybe do a trial run before you actually submit it to your actual to the actual IRS, right? So again, being consistent is sticking with one method and being consistent throughout the entire life of the business, okay? And then last but not least, comparability. You definitely want to make sure that you are following the rules and guidelines that is set out for all businesses in America, okay? Reason being is that because comparability, especially when we're comparing your information with another company's information, they need to look similar or if not the same, okay? They need to look very similar, especially if you're in the same industry as each other. So again, if I decide to open up a coffee shop, right, I need to compare my financial statements to other coffee shops such as Starbucks, Dietrich's, Dutch Brothers, Dunkin' Donuts, right? They are all in the industry of serving coffee, right? What are they doing better? What rules are they following that allows someone to take a look at our financial statements and be able to compare it to those exact businesses. Okay, so those are the 4 characteristics of financial statements, that it must be the 2 R's and the 2 C's. Reliable and relevant, consistent and comparable. Okay, so let's go ahead and talk about the 10 steps of the accounting cycle. So these is what it means to go through collecting the source document, recording the journals, and processing the business transaction and producing the financial statements. This is it. So again, this is a cycle, right? Once you complete from steps 1 all the way through 10, all right, you're going to repeat it again because a cycle is a full circle, right? So again, this is to 1, ensure the accuracy of your accounting, and 2, this also allows you to take the financial statements and make predictions and interpretations on those financial statements. So that's why you must complete the accounting cycle every single accounting period, which we will talk about in a few seconds here. So now I'm gonna walk you through every single step here for chapter 4. So you can see how much information do you need to actually be able to compile, and therefore you're going to make an executive decision on how your accounting period should be. So in this case, right, this is the 10 steps. And again, let's go ahead and take a look at number 1. Okay, so step 1 is to collect and verify your source documents. So once again, I've already given you examples of what these are, right? It could be receipts, it could be invoices, bills, checks, bank statements, okay? Contracts that you have with other individuals, Okay, so the purpose of this is you need to be able to collect it. Now, if you guys remember back then, if you're an accounting person, right, it is very common that they have a file cabinet that to file out all their receipts, all their invoices, and all their bills information, so they keep it as proof of a document. Yes, nowadays we have technology where we can snap a picture and upload it to our folder and call it a day. So same thing similar here, right? You can also have, if you charged your business credit card nowadays, because you have that little chip on there, right? You plug that chip in, it'd be able to read out and find all the receipts that you've collected or charged the card with. So again, technology is also helping us. So instead of having all these papers flying around, it makes it that much more easier to keep track of your proof of that a transaction has occurred, right? A bank statement, a credit card statement is going to obviously say that's a proof of transaction right there, okay? Now, of course, that's just the very first step, is just to collect and understand that a transaction has happened, because this is where the transaction analysis, right, the 7 steps of transaction analysis is actually going to start to come into play, where we collect our source document, understand that the business transaction has occurred, and then go through the whole entire steps, which is, how does this affect my business? And if so, what accounts did I use? And if so, then what accounts do I have in the chart of accounts? And then use the debit and credit system. So this is more or less step 1, which introduces you to the steps of the 7 steps of transaction analysis. Okay, so first one is to acknowledge, collect, and verify that a transaction has occurred with these possible source documents. Okay. Then step 2 is going to be analyzing and sorting. So this is where we take a receipt and we analyze and we answer the questions of the when, where, when, what, why, and how, right? So again, this example here is a receipt that we went to go buy office supplies for. So the why is we ran out of office supplies, so we need to buy office supplies, okay? Now in this case, let's go ahead and analyze it. So when did this happen? Usually the receipt will have an exact date and timestamp. Okay, so in this case, this transaction happened on June 6th of 2019. Okay, okay. Where did it happen? Obviously, the title and the store location is already there. Okay, so what happened? Well, what did you purchase? Okay, so in this case, right, we talked about the why. You ran out of business, you ran out of office supplies, so you went out to go buy it. Now, this is what you bought. You bought ink, you bought pens, and you bought paper. Okay, and then how? How is going to answer how much was the total amount and how did you pay? Okay, so in this case, how much? It cost me $61.09. How did I pay? I paid with cash. Okay, so that's how we analyze a source document, answering the who, what, when, where, why, and how. Okay, and then once we grab that information right now that we analyzed it, right, we collect it, now we have to figure out how we are going to sort it. So this is where step 5 and step 4 and step 5 is going to come into play, right? Because now we have our information, right? We know how we purchased these office supplies, right? We used cash and we have office supplies, right? So we have to figure out that in our chart of accounts, do we even have those accounts that exist? If not, you need to talk to your accountant to create those accounts for you in order to proceed with the actual recording. Okay. So then step 3, right, is where we're actually recording it in the general journal. So in this case, right, I acquired assets, right, by increasing my office supplies, okay, by $61.09, okay, and I had to decrease my asset, right, because I spent money. In order to spend money, I need to credit my account for $61.09, right? We practiced this yesterday, okay? So once you've done that, right, Step 4 is to post to the general ledger. So that's why yesterday I had to show you what the general journal is and what the difference is between the journal and the ledger. So in this case, the ledger gives me an account balance. So in this case, my cash account, right, says here that on June 1st, okay, this is the cash that I had on hand. I had $2,000 to begin with. And because I decided to purchase office supplies on June 6th, I recorded in my books exactly how I recorded in my journal. If I debited my account or credited my account, it would reflect exactly identical in my ledger. But in this case, I have another extension I have to do. I have the extra column that allows me to calculate how much cash I actually have on hand. So in this case, if I started with $2,000 and I spent $61.09, I should have now a total of $1,938.91. Okay. So again, it gives me an account balance of how much I have in each account. So on my chart accounts, I have an office supplies account and a cash account. And this is what it would look like, right? In this case, office supplies, I started out with none. So on June 6th, I increased my office supplies by $61.09. So therefore, I have a total balance of $61.09. Okay. Of course, we know what that exact items are, right? We bought printer ink, we bought pens, and we bought copy paper, right? So in this case, you would actually put that in your description so you exactly know what you bought and how much you buy instead of just putting in the number in there, okay? Just like that, right? So once step 4 has been completed, right? You post it to the journal, you post it to the ledger. The next thing that you're going to be occurring is going to be a trial balance. Now, it really depends on how often you do a trial balance, a regular trial balance. But once you reach the end of the accounting period, then you need to prepare what's called the unadjusted trial balance. Okay, so preparing the trial balance, right? Your main goal is you're testing to see if you did your accounting accurately by testing whether your total credits match your total debits. Okay, so then at the end of a trial balance, the goal is to make sure that your debits match your total credits. Okay, and again, this is to ensure that when you do use the journal, right, that you are putting money in a specific account and having that equal and opposite transaction, right? We talked about the debits equaling the credits in a journal as well. So making sure that you properly journalize this. Now, a lot of times the reason why you would have an imbalance in your trial balance is because due to human error, right? I may have journalized that I had $61.09, but I could have easily transferred that amount into my ledger as $61.06. Okay, so there's many reasons why we can have imperfect trial balance or imbalanced trial balances because of human error, okay? Or maybe we accidentally forgot to place the information in one of the accounts in the ledger, or I made a typo, okay? Or I put it in the wrong account, okay? Yes, it happens, okay? But once at the end of a trial balance, right, and you figured out that your total debits match your total credits. So here, let's take a look. We got cash, okay? We have office supplies. We have printer paper, we have a printer itself, like an actual equipment. We have equity. We have sales, and we have rent expense. Straightforward, pretty simple example here. So here we are even out with 3,860 debits with 3,860 credits. They match at the end of the unadjusted trial balance, okay? Once we get here and we verified that your debits match your credits, then the next step is going to be step 6, where we need to do or create our adjustment entries. Now, here's a catch, or here's a condition. Adjustment entries are only necessary to complete at the end of a given accounting period, okay? So whether it's daily, weekly, or monthly, right? It only happens at the end, okay? So let's emphasize the word end here, okay? Is going to be an adjustment entry. Now, what are adjustment entries? What are examples of how we can create an adjustment entry? Well, there's nothing really completely different between an adjustment entry versus a regular general journal. Except for that just happens at the end of a given accounting period. Now, what are typical things that you can adjust is the question you want to ask. So in this case, right, when we talk about periodic inventory, which we will in chapter 5, that's where it is necessary for us to complete what's called a conversion entry, which adjusts the inventory for you at the end of a given accounting period. All right, that is definitely going to be an example. We're going to take a look at that in chapter 6. Other examples of adjustment entries are going to be depreciation / amortization, which we will learn in chapter 11. Supplies expense, we will get to take a look at an example in the fictitious business. Cost of materials, cost of goods sold, right? All of that's going to be considered under inventory. And then, of course, any bad debt expense. Bad debt is going to be taught in chapter 10. Okay? So, again, these are going to be things that are going to affect your business company, especially when you're making adjustments. So, again, this example here where we talked about adjusting your office supplies, right? Because right now, my office supplies, no matter where I am at a given point in time, it still reflects that I still have $61.09. But what if you used those materials, right? What if you count them and said, well, I used half the stack of paper and I took out 2 pens out of the 5 pens that I bought. And of course, I put printer ink inside the printer. So I'm using them all, as I'm going through the business of operations, right? Operating my business, running my business. So therefore, I was able to determine that I end up using $50 worth of office supplies. Okay? $50 worth of office supplies. So therefore, right, I need to be able to adjust my office supplies, saying that I no longer have $50 worth of office supplies because I end up using them to print out, to send it to my customers, whatever reason I used them. Okay? And again, I had an accounts, in this case, I'm going to depreciate my printer. And because the way it is, I depreciate it by 83 cents. So once I've done my adjustments here, I'm going to go ahead and move on to step 7, which is preparing the adjusted trial balance. So in this case, right, we're going to go back to my ledger and post it, right? Every time you post to your journal, you must post it to your ledger. And in this case, right now, I have additional accounts that I must put into my adjusted trial balance, right? If you look carefully, my cash is the same, but my office supplies has decreased, right? I have 2 extra accounts in here for my depreciation expense and my office supplies expense for the 83 cents and for the $50. So in this case, it's just a matter of fact whether I transferred the amounts correctly when I did my adjustment. So in this case, my numbers still match at 380.60, 380.60. Okay. So once you've done that, that's where you're going to start creating your financial statements, okay? So step 8 is to complete your financial statements, starting with the very first one, which is going to be your income statement. So here's something also important you need to know too. When you do create your financial statements, you have to create them in a specific order. You cannot jump around and be able to do one without the other. Now, I'll give you an example here, right? When I complete the income statement, my income statement is going to be consisting of all of my revenues, subtract out all of my expenses to give me my net profit or net loss. Once I get this number, I have the choice to either reinvest into my company or not. And if I do, then I pop that into my statement of equity, because a component of statement of equity is to enter in whether you had net income or a net loss. So again, it is very crucial that you keep your financials and you create your financial statements in the exact order. Okay? So I complete number one in the financial statement should be the income statement to get my net profit or net loss. Then I'm going to create my statement of equity to plug in my net income or net loss to adjust the value, the net worth of my company. Once I get my equity value, right, I need to plug it into my balance sheet because I'm testing the accounting equation. I will get my first component, which is getting my equity from the statement of equity and plugging it into here. So all I'm really solving here is, does my accounting equation match at the end of the day? Does my total assets equal my total liabilities plus the equity I just solved in the previous financial statement? All right. Once I figure out that yes, my total assets was $23.09 and my total liabilities and equity was also reflected the same at $23.09, then yes, I successfully finish my 3 financial statements that are the most important to me. All right. And then, so once I get this liabilities and equity or my accounting equation to be equal to each other, right? Then the next step is going to be to do and complete the statement of cash flows, which is a combination between the income statement and the balance sheet. Okay? So that's the statement of cash flows. It's a combination between the income statement and the statement of cash flows. Balance sheet. Now, what is this combination? Well, again, you got to start with the net income, which you get from the income statement, and you're going to compare everything that you have on your balance sheet, right? Putting in office supplies, putting in your printer, right? Plugging in your cash flow. So again, your beginning cash flow that you started with to the ending cash flow that you ended with, which is the $2,248, right? At the end of the day, what you're trying to do here is actually see how much cash flowed into your company and how much cash flew out of your company. So by comparing your balance sheet with your income statement to produce the statement of cash flows, okay? And once you complete it, right, that's all 4 financial statements, then the next step is to close out your books, okay? So again, closing out the books, right, we talked about what temporary and permanent accounts are, right? Your permanent accounts, which is your asset, liability, and your equity, will never close out at any given accounting period. However, your revenues and your expenses do, because this is the perfect way to measure profitability at a given time period, right? If you close them out, you start at 0 at every single either month, quarter, or at the end of the year, right? You start at 0 at every single given time and period to make sure that when you do run your reports, you can measure, rather if it's month to month, you can measure, okay, this month I had sales that were very high in the month of June, okay? And then July, I had obviously 4th of July, I increased my sales, but at the same time, I also increased my cost because I had to market myself for the 4th of July sale. So then you're going to see a huge fluctuation, and that's going to be considered statistics information that you can use for the rest of your company, right? What can I do to maximize my profits? What can I do to lower my costs, but at the same time be able to maximize my profits in regards to this? Maybe I need to sell different types of coffee. Maybe during the summer, instead of selling hot coffee, I sell iced or blended coffees. Okay? So again, any kind of method that you could do, you could take the statistic value of running your reports either every single month to kind of get some kind of information that you can tailor to your business to either better yourself or find where the issues are, which is I'm spending too much money on advertising, or I need to raise my prices so then I'm able to cover for all the expenses I incur for operating the business, right? To cover for rent, to cover for utilities, to cover for making payments to my employees, okay? So that's exactly what we do here, and we're going to close our books out to equity, all right? Now, in this case, right, we're going to close out all of my revenues to the income summary because it depends on what kind of business you are. If you're a sole proprietor, you have what's called income summary. Corporations use retained earnings. Partners use partners' profits, okay? So make sure you guys understand that every single company has a specific type of means to reflect equity. Okay, so in this case, we're going to close out our revenues to our income summary and close out all of our expenses to income summary, and then we close out our income summary to equity. Okay, so that's what this exact journal is here. Okay. And then once you've done that, you need to also create your last statement here, or in this case, your last report, which is going to be the post-closing trial balance. Because once again, we closed out our books to make sure that we end with our equity with the way that we should end our equity. Okay, which should be the 230917. Right? Making sure that we did our journalizing properly to properly zero out all of our accounts. Okay, and that is it for the accounting cycle, all 10 steps right there. So imagine this, if you're a big company, when should you complete the accounting cycle? If you're a big company, you shouldn't wait till the very last minute to do this. So you should be able to run it every single day. But if you're a smaller business that gets sales here and there, then yes, you can, leave it off to the end of the week to complete your accounting cycle, because there's a lot of steps, a lot of things that you have to complete, and a lot of things that you have to do in order to complete the accounting cycle. Okay? Any questions?
No, not really.
All right. In this class, we will go through the entire accounting cycle. So by the end of this class, you will be able to successfully be able to complete all 10 steps of the accounting cycle. Okay? So that's my goal here is for the first 10 weeks, I'm only going to be showing you how to complete steps 1 through 3, which is collecting your source document, interpreting and analyzing and sorting your information, and journalizing it in your journal. Okay? I'm only going to teach you steps 1 through 3. Once we reach the fictitious business, that's where I'm going to show you and have you practice all 10 steps of the accounting cycle. So again, for the first 10 weeks, I'm going to show you the ins and outs of every single concept that we will learn. And then the last 5 weeks of class, we're going to apply all of that into one and combine it into one fictitious business that allows us to be able to journalize any transaction that comes our way, whether it's a revenue, whether it's dealing with purchasing fixed assets, whether it's us to depreciate fixed assets, right? We're going to do it all, okay? All right, so let's talk about what an accounting period is, because I mentioned accounting period a bunch of times throughout this entire accounting cycle, right? The easiest way to understand it is going to be when you actually want to complete the accounting cycle. Simple, okay? Do you want to complete the accounting cycle every day, every week, every 6 months, right? Every month, every quarter, every year, okay? And this is what I was talking about, right? It's basically the accounting period is when you want to schedule to complete the accounting cycle. So all 10 steps, right? So that means, like I've mentioned before, right? It's a circle, it's a cycle, right? Once you complete that 10 steps, depending on which accounting period works best for you, right? Most common for all types of businesses, they generally would do it at the end of the month, at the end of a quarter, or at the end of the year, okay? Very rare do I see daily or weekly or semi-annually. But other things like banks, so if you go into a bank teller, right? That is actually where you actually have to do accounting every single day, where you have to run the register to make sure that the amount of money that you started out with at the end of the day is the amount, and then is equal to the amount of money that you completed your transactions with for that entire day. So in this case, a bank is going to want to run their reports, run through the accounting cycle every single day, especially because you're dealing with money, right? It's the U.S. Treasury money. So that's definitely something, an example of what you could do for every single day, right? And again, but most typically, the best way to actually see that a business is doing well is to measure it by per month or per quarter or per year. Okay. And then down below is going to be something that is going to be relevant for when you actually are filing your taxes, okay? So again, you can choose to file your taxes based on either a calendar year or a fiscal year, right? You probably heard more commonly fiscal year, but in this case, calendar year is pretty straightforward, right? When you submit your, what do you call it? Your taxes to the IRS, right? That's what you have to do. You have to do it every single year. So again, this is separate from your completing the accounting cycle because this is internal, right? But the reason why you do create these financial statements is because at the end of the year, you're going to compile those financial statements and submit them to the IRS. So that's why, depending on what kind of business you are, whether it makes sense for you to do it every year based on a calendar year or based on a fiscal year. So again, calendar year is where you're going to start recording your transactions as of January 1st of that year, and you're going to end your accounting period, or you end the stopping transactions or stop recording your transactions at the end of December 31st of that year. That is calendar year, okay? Where fiscal year, right, is any 12 consecutive months where you record on the first day of the first of the month, and then you end your recording at the end of the 12th month, the last day of the 12th month. Okay. Now again, why is this relevant? Now for most cases, right, a calendar year, right, it just depends on how busy you are during certain given time periods. So an example of a calendar year, right, would be a swimsuit company, right? Their sales or their busiest time of year is usually from the spring to the summer and maybe fall, because there are some fall sports there, right? And maybe occasionally during the winter. But if it's consumers for the whole entire public, their highest sales would be somewhere in the summertime, right? So they're going to be a lot more busier during the month of June, July, August, and September. Now, in this case, right, that means they have no time to be able to wrap up everything and be able to produce the statements that they need to filed the taxes to the IRS. But when it becomes winter season, right, sometime in December, it's slower those days because who wants to buy a bathing suit in the middle of winter? Not many people, unless they're doing professional sports. So in that kind of idea, right? Therefore, they have all the time in the world to produce their financial statements, to be able to file the tax forms that they have to do, and file their taxes through the IRS. They have more time during the winter. And that would be a perfect example for a swimsuit company to start their journalizing in the beginning of January and end it on the last day of December. Okay? All right? And most cases, right, for personal taxes, that is exactly the same here, right? We always file our taxes starting from January all the way to April, right? Because our tax year starts the January 1st of the year and it ends December of that year. That's our taxes. Personal taxes go through or go by the calendar year. Okay? Now, for fiscal year, right, it's going to be anything that it's any 12 consecutive months. So if they want to start on May 1st and end their accounting period April 30th, then so be it. If they want to start November 1st or let's do October 1st and end it September 30th, that's completely fine. It just depends on what the type of business is, right? Again, what's their main selling point or what's their profit point, right? In this case, right, a great example is that most government agencies, usually their fiscal year starts July 1st and ends on June 30th, okay? Most government agencies, so whether it's the state, right? Any federal or state funding, usually their fiscal year starts on July 1st, okay? And ends June 30th. Why is that so important? It's because think about it. The government is a lot less busy in the summer because they're wrapping it up their budget. They see that they have so much money, so what they do is they try to spend it before they can't have that money back, right? It's not like a retained where they can save that money and it goes over to the next year. No. The way that the government is you get budget money, and if you don't use it, you lose it. Okay? So that's why usually during the summer, it's just because they're trying to wrap up the rest of their end of their budget, right? That, it's not more so busy, right? But what's the most busiest is during the month of November, December, January. Why? We have new elected officials in November. We have new tax tables that are done in December. And then January is when we implement them. So again, the government is extremely busy between November, December, and January. Why? Because of all of these new things that are occurring that year. So that is exactly why they are not going to spend all their time, going through the IRS, right, processing their paperwork that time because they're too busy either helping the candidates get their money, they're too busy focusing on what budget to use, and also they're focusing on what tax tables to create to help society. So, and that is a great example of a company that would use fiscal year over a calendar year. So again, it's going to be based on how busy you are during the season and which one makes it easier for you. Now, of course, if you're anything like me, I do have a hard time trying to figure out what dates are, okay? As funny as it sounds, I can't remember what happened today or the next day. So the best way to memorize not fiscal year or when to file my taxes is I'm just going to go ahead and go to calendar year because at least I know I start on January 1st and I end on December 31st. Okay? Simple. Okay? All right, any questions right here or up to here?
No.
Okay. So now we're going to talk about the generally accepted accounting principles. These are going to be the rules and guidelines that you must follow in order to complete accounting. Okay? Now let's talk about what these are. It is a especially for financial statements and any processes that basically how to journalize and things, all those rules are created by FASB. Okay, FASB is the Federal Accounting Standards Board. Okay, FASB for short. Okay, now what they do is they create a series of rules and guidelines that governs the way you do accounting. Okay, now in this case, right, in the United States, we only use the United States GAAP. GAAP standing for Generally Accepted Accounting Principles, right? We are very special because we create our own rules for the United States, okay? If you go to Canada and do business there, they have a slight modification of GAAP, but that's why we refer US GAAP as US GAAP, because this GAAP rule only affects United States, okay? Not America, the United States, okay? So make sure you keep in mind that FASB has created these rules specifically to be tailored to the United States, okay? Now again, like I mentioned before, if you go to Canada, they'll have a slightly modified version of GAAP. You go to Mexico, same thing, a slightly modified version of GAAP. If you go overseas, where you're going into European countries, they have a whole set of different rules, including other foreign countries such as Asia, Africa, and also South America. They also use completely different accounting principles, right? And those accounting principles are called the IFRS, which is the International Reporting Standards, International Financial Reporting Standards, okay, the IFRS, okay. Now let's go back to talking about FASB. Now FASB again is going to be the organization that creates or governs the rules created for the United States GAAP, okay. They're the ones that create these rules, and they're the ones who also are the ones that are double checking your work, especially when you go submit your statements into the IRS. They're going to be making sure that you follow the rules and guidelines, because if not, yes, you can get fined. Now, of course, for small businesses who can get away with some rules and stuff, they do have a completely separate way of looking at your financial reports if you are a sole proprietor. And we'll talk a few rules and guidelines that small businesses can actually get away with, right? Instead of having to pay taxes for a small business, right, at the end of every week, right, especially if they're a small business, they can get away with doing it every quarterly or at the end of the year, okay? Now, where major corporations, no, you're collecting money on the daily, so they're able to grab that money instantly, okay? So that would be an example here where they kind of, it's government involvement here in regards to, making sure that you follow the accounting rules and standards. When you file your taxes, they are going to fine you, especially for corporations, right? And that's exactly why you need to pursue a CPA. You need to be a certified professional, okay, in public accounting, okay? So you don't make these mistakes and get fined for doing these mistakes because it could pose potential fraud, okay? So that is the United States, right? The United States GAAP is governed by or created by FASB, okay? Now, when we talk about international, right, something that's very close or very similar because of, language, but of course, monetary is a little different. But the closest one or the next biggest organization that's out there is going to be the International Accounting Standards Board, known as ISB, okay? International Accounting Standards Board. And they are responsible for creating the IFRS, the International Financial Reporting Standards, okay? So in this case, right, it's based in London, England, okay? And they actually govern a bunch of European countries and including some countries in Asia, okay? Now, of course, as I've mentioned before, right, there's probably a huge different type of accounting rules that are in place for other countries. So as I mentioned before, right, Asia and Africa and I believe South America have their own accounting standards, okay? Now, again, like I mentioned before, the next biggest one is the IFRS. And again, it covers most of Europe and a few countries surrounding it, okay? Of course, now that's why oftentimes when you do your research, it is very important that you're making sure which kind of article you're reading, whether it's the United States or whether it's from the UK, because they're just similar in language. It's oftentimes that they do, appear, and the rules of the international is completely drastically different than the United States GAAP, okay? Now, yes, back then when I was going to school, okay, this was way back in 2012, okay, there was a talk about how the United States GAAP was trying to get together, the FASB was trying to get with the ISB to create a universal standards of accounting rules and guidelines. Okay, now it is fast forward 2021, and that still is going into works. Okay, because like I said again, the United States GAAP is drastically different than IFRS. Okay, so if you read or try to attempt to do international accounting, it's the rules are so different that it might be even more difficult to understand. So if you do plan on trying to create a business overseas, the best bet is that you need to have somebody who's professional in that country to be able to know their own country's accounting standards, okay? Because every country is different, okay? In our case, not our country. In our country, we're the United States GAAP, so we're only going to be focusing on GAAP. So in this case, this is just information for you because right now we're currently in the United States, so we are going to be learning the United States GAAP. Okay. So let's go ahead and dive right into United States GAAP. All right, there are a total of 12. Currently, there are 12 rules that are set into place right now. Obviously, these are the general ones. As you do progress in accounting, you're going to learn that there's a whole book on these set of rules. But this is just to understand the very basics of journalizing and how to go on forth from there, okay? Again, once you do go into more advanced levels of accounting, there's a whole set of rules that you have to follow, especially if you go up into corporation. There's even more rules that you have to follow because you want to be interested in a publicly traded company. So in this case, right, let's talk about the first 4, which are going to be your assumptions. So number 1 is going to be the business or economic entity, all right? Definition here basically says that you must find some kind of way to separate your personal from your business, okay? So your personal transactions must be separate and must be dealt with separately than your business transaction, okay? So a great example is if you are planning to create your own business as a sole proprietor, you need to create at least a separate bank account for your personal and for your business. Straightforward, right? That way, it makes it that much easier to keep track of your personal transactions and your business transactions, right? You'll have 2 different bank cards. And of course, with ethics, you need to make sure you make that executive decision to make sure that is it okay to charge this transaction if it's meant for the business. Okay. The second rule here is going to be going concern, okay? Now, in this one, this definition basically tells us that even if there is a foreseen event, meaning or like for example, closure, right? You've already predicted this. You're going to continue running your business as if nothing is going on. So in this case, you're going to continue doing business as usual, all right? Even if you already have a foreseen event, right, such as a future closing, if the company is going down, you're still going to continue doing business as usual until you shut the doors, okay? So a great example is going to be Sears, okay? Nowadays, we know that Sears was one of those huge major companies that's been around for a couple years, and they are no longer available, okay? So even though Sears had a foreseen foreclosure, right? They knew that they were going to close the company. They still kept their doors open to continue doing sales, right? They try to get rid of their inventory until the day that they officially announced the day that they closed their doors and stopped doing business, okay? So even if there is a foreseen foreclosure, you're still going to continue selling out your inventory as much as possible, right? In this case, they still continue doing their business, right? They just added more discounts and basically liquidated their assets, okay? So in this case, that's a great example of the going concern assumption, okay? Next is going to be monetary assumption. Now, in this case, it's split into 3 different subsections, or I guess categories, which is number 1 is going to be monetary unit. Now, in this case, right, monetary unit basically tells us that you need to use the most relevant form of currency. Well, that's easy. We live in the United States, so our best form of currency is going to be the US dollar. Okay? Number 2 is going to be monetary measurement. So this goes in regards to journalizing. Okay? So monetary measurement tells us that all events must be recorded in terms of monetary value. So what does that mean? So I'll give you an example here, right? Your company has a bunch of employees, right? You have 20 employees. In your books, you cannot write that you have 20 employees. You must write that you have the total cost of all 20 employees. So in this case, I could say I have $50,000 worth of employees. Okay? So again, instead, this is the rule for journalizing. You cannot journalize quantity. You must journalize total value. Okay? So nowhere in your journal can you say I have to pay 20 employees. You can only record their total expense for the total cost or the total value of 20 employees. Okay? And then number 3 is going to be stable currency, where a unit of currency is stable and it does not take inflation into consideration. Now, with that being said, right, we know that the United States dollar is pretty stable, right? We know that the change or the drastic value of a dollar does actually not change that much over the span of the years, right? It might change a few cents here and there, but at least the dollar, right, in terms of time-wise, right, it's still going to be $1 tomorrow. It's still going to be $1 in 10 years. It's still going to be $1 in 20 years, right? That's going to be considered a stable form of currency. Now, of course, we know with inflation and recession, right, the actual true value of the dollar will either increase or decrease depending on what the circumstances is of the current event. So in this case, right now we're in a pandemic. The value of the dollar plummeted really, really down. It is so low that $1, comparing it to other countries, it's very, very low. It's lost its value due to the circumstances of the current event. Okay. Now, of course, but what this means right here, this stable unit, right, allows us to make predictions without having to assume inflation. Because if $1 exists today in 2021, that means $1 is going to be the same exact amount fast forward 5 years from now. So again, maybe 2025, that dollar is still going to be $1, right? In context, right? It's not like we're printing, dollar and a half. No, that dollar is going to retain its value as $1 over time. So that allows us to make predictions without having inflation involved. So if I want to go get a bank bond, right? At least I know if I put $1 in the bank right now, it's going to be at least $10 in 5 years, right? That's the assumption here, that you want to use some kind of stable currency and etc. to be able to make predictions in regards to future predictions, okay? So that's the stable currency. Now again, in this case, I'm not going to ask you specific questions on the categories. I'm just going to ask you, right? If this is this, right? Can you tell me which rule it is? And if you say monetary, I will accept it, because again, I'm not going to expect you to tell me it's stable currency, it's monetary measurement. No, as long as you know it's monetary assumption is all I care about. Okay. Last but not least is going to be the accounting period assumption. So this is where the government allows you to break your accounting period into smaller sections, such as in a way to be able to measure profitability or to run your reports. So again, the IRS or the government, GAAP, FASB, they tell you, hey, even though you need to submit your reports to the IRS at the end of the year, I'm going to allow you to be able to break down your accounting period in measurable ways to measure profitability. Okay? So in this case example, right? Any accounting period could be every month, right? To run monthly profit and losses, so then you're able to measure your profitability on a month-to-month basis. Okay? So again, GAAP allows you to do that, right? Now, as far as reporting it to the IRS, no, you only do need to do it one time. But if you are a corporation, right, they require you to post your financial statements on your official website every quarterly. Yeah, every quarter you'll see the report that's posted on the official website. And then at the end of the year, when they finally process it through the IRS and get that approval of whatever that their financial statements is correct, they must post it on their website to have it available for any person who's involved with that company, right? Shareholders. Okay. So again, yes, so allows you to break the accounting period into whatever makes it easier for your business, okay? Any questions here for the accounting assumptions?
No.
No.
Okay. Okay. Next, I'm going to talk about is your basic principles. Okay. Your basic principles are going to be these four, which is going to be number one, your historical cost principle. Now, in this case, right, the definition basically tells us that by recording specific transactions, especially when you're purchasing either inventory, any fixed assets, any, intangible assets, whatever kind of assets that you purchase, right, you must record it at historical cost value, or also known as fair market value, meaning the day that you bought it is the day that it's the amount that you're going to record your asset at. Okay? The only exception to this rule is going to be inventory and any bank securities, because obviously, right, if you're going to purchase a bank security, at the end of the day, you're going to redeem it at a higher value. All right, where in inventory in chapter 6, we'll talk about the lower cost of market, where when you purchase inventory and you keep it in your shop for so long, eventually over time, that inventory item will lose its value and you must adjust it in your books accordingly, because again, you wouldn't be able to sell that item for the same exact price and it would not hold its value. Because due to advancements of technology. Okay, so again, these ones are the exception to the rule. However, what does it mean when you have to record something at historical cost? In this case, right, you cannot miraculously add value to an item. Okay, so example, right, you purchase a home, right? Yes, you purchase a home, and 20 years later, the price, the value of the house goes up, right? In accounting, no, no, no. You cannot put that in your books. You cannot create invisible money out of nowhere. So the only time that you'd be able to recognize that gain is by selling that property and then recognizing that you got a gain out of it. Okay? So again, historical cost basically tells you you cannot increase or decrease the value after you made the purchase. So whatever you purchase it out, the fair market value of that current date, you record it and you keep it and remaining in your books until you sell it. All right. So a great example here is if you bought a machine for $50,000, okay, and of course when you eventually will depreciate it, you don't actually take it off the value of the actual asset, right? And we'll talk about that in depreciation when we dive into that in chapter 11. However, we purchased it on this date for $50,000, and it will stay in your books and for 50,000 until the day you get rid of it or sell it, or it's reached its end of its life and you need to just get rid of it. Okay, so at the end of the day, you cannot add any value to a fixed asset. Okay, also I guess other circumstances is if you fix it. Okay, if you add fixtures or maintenance it, in this case, you don't actually add value, you just extend its life. And we'll talk about that in chapter 11. Okay. The second one we have here is going to be realization, or also known as revenue recognition. Okay. Now, this is where you record your revenues when it has been realized, or in straightforward term is when you earn it. Okay? So when you sell a product, the day that you sell it is going to, the day that you got rid of the item too, right, is going to be the day that you recognize that you earned the money or you earned the revenue. Okay? So this one kind of goes along in the same aspects of accrual type based accounting, right? So an example is going to be you're going to record a sale of an item or service the same day or at the time of sale, right? You're going to record that you earned it because you either sold the product or you sold the service, right? It's been completed. It's going to be the day that you record that you earned your revenue. Okay, so I guess another example is I sold somebody a book. So therefore, in my books, I'm going to record that I earned the money even if I don't receive money. Okay, I earned the revenue because I sold and got rid of my book. Okay. And then matching principle is going to be where all your expenses and that are associated with gaining that revenue, you need to match them 100%. So this one is going to go hand in hand with revenue recognition because, again, if I sold my item, right, how much did the item cost you? What was your profit margin? All right? Those are what you're going to match your expenses because cost of goods sold is an expense account, right? It's directly correlated to your inventory. Your inventory is an asset account. Okay? So again, you're matching your expenses. So all expenses are matched with every single revenue that you generate. Okay? So again, a great example again, when you sell, when the sale has again occurred, the way that you would match the revenues with the expense would be matching it through the cost of goods sold and also the cash and the profits that you earned. Okay. Last but not least is going to be adequate disclosure. So we talked about the example for monetary measurement, okay? In this case, right, what adequate disclosure is going to be any other information that's pertaining to a specific transaction. There's a place called notes to the financial statements that you're able to put this extra information in. So again, we talked about 20 employees, right? Or in this case, we talked about having employees. Now, in this case, if I journalize it in my journal that I have 20 employees that cost me a total of $50,000 in salaries and wages. Now, do I know exactly how much each employee earns? Do I know exactly how much each employee in perspective gets, how often I pay them? Are they salary based or are they wage based? So this is where the notes to the financial statement allows you to place that information in there because it's pertaining the transaction, right? So if you notice that most businesses, right, when you do these kind of things, when you run your reports, they have a list of all the people that work for the company, right? Obviously, the values of what they earn and stuff isn't technically revealed, but they do say they give you a net worth, right? Saying, well, the president net worth is roughly $100,000, while a simple accountant is going to make roughly $60,000. You know, example like that. And they're salary based, right? Well, I have my regular employees, right, earn maybe $10.50 an hour. And I have full-time employees and part-time employees. So all of that information that I just said right there is going to be listed into the notes of the financial statements. Okay? You're nowhere to be able to put this in your journal. Okay? Why? Because the journal is strictly only for day-to-day transactions. You cannot flood your journal with all of this extra information. There is an actual place to put it. Okay? All right? Any questions in regards to the basic principles?
No.
Okay. Let's go ahead and talk about last but not least. The last four principles here are going to be your constraints and your conventions, okay? Now, in this case, number one is going to be materiality convention. This is if a transaction or an item is significant enough for you to be able to record it. If it's not, then just ignore it. Okay? So in context, what does that mean? So a great example is going to be where, let's say you purchase an asset, right? You purchase a $5 trash can. Now, is a $5 trash can, is that significant enough for you to record that as an asset? Like, can you keep that as in this case, if you consider furniture, right? Is a $5 trash can significant enough for you to consider this as a fixed asset? No, it's only $5. You're better off just running an office as an office supplies expense, right? You just make a mere expense for the company. Whereas another example would be, what if I bought a $10,000 machine for me to be able to produce the products I sell? That is 100% going to be a significant value that will affect your total assets. So that is the materiality rule here, is where you need to make executive decisions whether something as small as a $5 trash can, is it worth it to record it as a fixed asset where you can purchase, other things that could be more worth it. Okay? So that's up to the decision of the accountant and also whoever's running the business. They need to make that executive decision. Is it worth it to recognize as a transaction? Okay. Number 2 is going to be a cost-benefit convention, okay, where you have the benefit of providing financial statements, and it should be weighted based on the benefits and costs of producing it. So in this case, right, the question here is, if you're running a small company, right, if it costs you money to have to produce your financial statements, is it worth it to even do it in the first place? Okay, what benefit does it have for you to be able to produce those financial statements, right? Because again, we talked about financial statements. Benefit would be it will go to an external user that could potentially want to invest in your company. But what does it do for your internal? I can't earn money from my internal users, but my internal users could use that information to maybe make predictions or, find a way to increase my profits. All right. So you're going to have to weigh the options against your cost to your benefit. Is it beneficial for you to produce it, even though it's going to cost you significant value? So again, in this case, you're going to have 2 alternative options. So again, option number 1 is, this is an example, if you are a t-shirt type of company, okay? And let's say your option number 1 is it worth it? Is it worth it to produce your products in the United States? Because the benefit is that you can get a 24-hour turnover, but the cost of that is going to be significantly high. Where your option 2 is, let's say I decide to ship it overseas and have the product create overseas. The turnover time is going to be, it won't get here until a week later, but the cost is significantly low. Now, in this case, that's going to be something that you have to discuss. Is it worth it to spend more money so that you can sell the product instantly? Or is it going to be better for you to spend less money but have to wait a whole week and losing out a whole profit's worth of a whole week's of profit? Okay, so that's the example here on cost benefit convention. Okay? And then of course you have the conservatism convention, okay, where In this case, this is going to be linked to the cost benefit convention, okay? Where out of the options or out of the alternative options, you would choose the one that would least likely overstate your assets. Okay, so in this case, right, I have another example, right, where we talk about collecting sales tax. Now, as we know, sales tax, excuse me, not sales tax, where we sell a product, right, when we talk about costing for inventory, where you have 1.85 and a half cents, okay? And you need to round it either down because that way it will least likely overstate your assets. Because if you round up, right, therefore you're saying the value of your inventory is significantly higher than what it should normally be. So in this case, your best bet is to round it down, okay? So another example here that I said was tax, right? Tax is what? 1.87, 1.8375 or 735, something like that, right? And because you have those extra numbers, right? What is your obligation? If you have a split penny, you're obviously going to increase or round up because the government wants their money. You don't want to overstate your assets because in this case, right, it's the government that you're dealing with. You definitely want to make sure you don't overstate your assets by rounding down because then it's going to hurt your business and it's going to hurt the government that's going to come after you. Okay, so you never want to round down when it comes to the government. You always want to round up for sales tax. Okay. And then last but not least, industry practices. So if you guys remember from the very beginning of this PowerPoint, I told you about comparability, right? Your financial statements must be comparable, okay? So in this case, right, what does industry practice actually do? It is a set of customary rules that in a specific industry that they follow, all right? And if you're in that same industry, you are more likely to want to look at other businesses in the same industry to compare and see what they're doing, and then you would tend to follow what their custom, guidelines and rules that to make their company a better company. Okay, so I gave you an example, right? If you own a coffee shop, you would definitely want to compare your financial statements to somebody like Starbucks, Dietrich's Coffee, Dunkin' Donuts, Dutch Bros, right? Because they're all in the same industry. They're all in the same restaurant industry, and even specifically, they sell a specific beverage product that you also sell. So your best bet is, why are these companies doing so well compared to your company, right? And you would tend to gear towards the same aspects, right? You would try to make your financial statements look somewhat but similar to their financial statements because they're so successful. So that's what industry practices does. It's a set of customary rules that a specific industry has and that you tend to want to follow or have those same characteristics in your financial statements. Okay? Oh. Any questions in regards to constraints and conventions?
No.
Okay. For this exam, or just for this class in general, I'm only going to test you on the first 8 principles that we looked at. So your assumptions and your principles, because constraints and conventions are more so for cost accounting / managerial accounting, right? Why do you need to decide whether something is going to overstate your assets, right? Why do you need to make sure if this is going to affect your assets, right? You don't need to make that decision. Your only job is to record. So you're being told what to do. Why do you need to make alternative decisions? Why do you need to choose the one that's going to least likely to, because the way it costs, right? You're not responsible for this. And on top of that, you're not responsible to create your financial statements based on someone else's, right? Your job isn't to compare your financial statements to other people. So again, this is cost/managerial accounting that these principles will go along with, because if you're producing a product, yes, you should find some kind of means to make some kind of cost benefit scenario, right? And again, if you're trying to compare yourself to another company that's in the business, you're going to see how they do their costs and how they do their spending and so on and so forth, and how they keep their costs low but producing a quality product. That is not your job. Your job is to simply record the business transactions. So all of these are going to be considered managerial accounting ideas. So I'm not going to test you on these last four concepts here, okay? I'll only want you to just know them, all right? So we're going to stop here because it is now exactly 10 o'clock. We're going to call break now, so please be back no later than 10:20, okay? And I'll see you back here in 20 minutes.